exercise 1. Now we have chapter 6. We have cornerstone exercise 10-1. Actually, muna siya ang 6-1. 6-1 in our text. So we have 6-1 for the following requirements in 1, 2, and 3. Okay, so the problem now involved calculation of average operating assets, margin, turnover, return on investment. The company provided the following information for two of its divisions for last year. Okay, so we have now for the three requirements, 1, 2, and 3. We have common sub-requirements. Letter A, number 1, for the small appliances division, compute for the average operating assets, margin, turnover, and the return on investment, or the ROI. Now we are given the two divisions for the small appliances and the cleaning products divisions. So we have now the first requirement for the average operating assets. We are now going to add the beginning and the ending operating assets, and then we divide it by 2. So we now have the beginning and the ending operating assets divided by 2. So that in the case of letter A, we have now 6394 and 5,000 here for the operating assets. 6394 and 7474. Total in millions divided by 2. So we have 6934 millions. We have now your average operating assets simply by adding the beginning and the ending operating assets divided by 2. Second requirement is the margin. Formula is operating income divided by sales. So we have the operating income divided by sales, giving us 8%. Okay, that's your margin. Next, we have the turnover. Formula is dividing sales by the average operating assets. So we have the sales of 34,670,000 divided by the average operating assets. So the turnover is 5. And the ROI is taken by multiplying the margin by the turnover. So the margin is 8% or 0.08, and then we multiply it by 5. So the ROI is 40%. Now, second, we have to compute the same items. And requirement number 2 is for the cleaning products division. So again, we have the beginning and the ending inventories divided by 2. We have now the average operating assets. Then for the margin, we divide the operating income by sales. So the operating income divided by sales, or 4%. That's the margin. The turnover is taken by dividing sales by the average operating assets computed in number or in letter A. So turnover is 5.4, and the ROI is taken by multiplying the margin times the turnover. So the margin of 4% multiplied by turnover, 21.6%. By the way, the turnover is stated in number of times, while the margin is stated in percentage. So we have now the turnover taken at or at 5.4 times your sales, no, turnover related to the operating assets. So you now get 5.4, which you have to multiply by the margin. That will give you the ROI. Now in question number 3, what if operating income for the small appliances division was 2 million instead of 2,773,000? How would that affect average operating assets, margin, turnover, and ROI? Calculate any change ratios. Round to 4 decimal digits. So we now compute for the new operating income is just 2 million, which is lower. Now for both margin and ROI will be affected. So the new operating income is lower, therefore both margin and ROI would be lower. Average operating assets and turnover would be unaffected since operating income is not a part of the equations. So your average operating assets will still be the same as in requirement number 1. And at the same time, your turnover is still the same, equal to the turnover is 5 and the margin is 8. The average operating assets mo man nagyapon ng 6,934,000 and the turnover is 5. So what are now the changes in our solutions? For number 3, so the new margin is taken by dividing the new operating income by sales. So the new margin will only be 5.77% in lieu of 8. And your that's your new margin. And the new ROI, or the return on investment, if you have the new ROI taken by multiplying 5.77%, that's your margin, and then we multiply it by the turnover of 5. In the case of 1C, so it's 5. So you now get the new ROI equal to 28.85% instead of 40% in requirement for number 1. Okay, now we go to problem number 2, cornerstone exercise 10-2. That's 6-2 in our book. Calculating residual income. The company referred to number 1 requires an 8% minimum rate of return. Calculate the residual income for the small appliance division and the residual income for the cleaning products division. So we have now the residual income for the small appliance, the operating income minus the minimum rate of return times the operating assets. So we have now your residual income for 2,773,600. That's the operating income. And then we deduct 8% of the average operating assets. Okay, so we have now the result, which is 2,218,800. After comparing 18%, now you are given the 18 percent here for the 8%, I mean. So 8% of the average operating assets, and we finally get the residual income since the operating income exceeds the minimum rate of return. We have a positive residual balance. Then for the cleaning products division, the operating income, which is 1,252,800, and then we deduct 8% by the operating assets of 5,800,000. That's the average operating assets. The average operating assets of 5.8 million. So we now get the difference, since we have now your operating income of 1,252,800 minus 8% of 5,800,000. Still, that gives us 788,800. That's your residual income. What if the minimum required rate of return was 9%? How would that affect the residual income of the two divisions? So, kung 9% in the case of requirement number 3, if the minimum rate of return was 9%, the residual income of both divisions would be lower. So, for the small appliance division, we are now computing the after-tax cost of mortgage, no? We have for the small appliance division residual income, 2,773,600. That's the operating income minus 9% of the average operating assets. So it gives only 2,149,540 for the operating income. And for the cleaning products division, we have 1,252,800. That's the operating income minus 9% of the average operating assets. So we only get 730,800. Now take note of the formula in determining your return on investment and your residual income. Now we go to problem exercise 6.3, calculating weighted average cost of capital and economic value added. Ignatius Incorporated had after-tax operating income last year, that's already after tax, of 1,196,500. Three sources of financing were used by the company. 2 million of mortgage bonds at 4% interest, 4 million of unsecured bonds paying 6% interest, and 9 million in common stock, which was considered to be relatively risky with a risk premium of 8%. The rate on long-term treasuries is 4%. Ignatius pays a marginal tax rate of 30%. So calculate the after-tax cost of each method of financing. Now, the after-tax cost of the mortgage bonds actually of 2 million. So you have the interest rate minus the tax rate times the interest rate. So we have the interest rate given at 4%, and you multiply 30% times 4%. So actually your 30%, that's the tax rate, and the interest rate is 4%. Now, here it's stated that we have the tax rate of 30%. So the after-tax cost of each method of financing is for the bonds, the mortgage bonds, the interest rate is 4%. Then we deduct the result of multiplying the tax rate and the interest rate. So we have 0.3 multiplied by 0.04. So that actually gives the result, the after-tax cost of mortgage bonds, which is equal to 0.028. So that's taken by multiplying the interest rate of 4% by the result of multiplying the tax rate times the interest rate. So actually you have 0.04, and then we have now 0.012. You get 0.028. That's your amount of after-tax cost of mortgage bonds. Now, the after-tax cost of the unsecured bonds. The unsecured bonds amounted to 4 million. So, we have the interest rate of the unsecured bonds equal to 6%. And then we multiply the interest rate of 6% by the income tax rate of 30%. So that gives us 0.06, and then we deduct the tax rate times the interest rate. So the answer is 0.042 for the after-tax cost of the unsecured bonds. Now we have number 3. Calculate the economic value added for Ignatius for last year. Is the company creating or destroying wealth? So the economic value added first in number 2, we are going to compute for the weighted average cost of capital. Calculate the total dollar amount of capital employed for Ignacio. So the weighted average cost of capital is, first we have to add the amounts of investments in mortgage bonds, unsecured bonds, and common stock. So the total of capitalization is 15 million. Then we get the proportion dividing 2 by 15. It's 13.33%. 4 divided by 15 and 9 divided by 15. So we are now dealing with the percentages. If you add the 3, now that will give you 100%. And the after-tax cost computed in number 1, we have 0.028, 0.042, and 0.120. And the weighted cost is taken by multiplying 0.1333 by 0.042, no? 0.2667, that's the percent. And the common stock percentage is taken by dividing 9 over 15. So all in all, the percentages total is 100%. And you are now going to fill up the after-tax cost computed in number 1. Finally, we have the weighted cost. So the weighted cost is 0.0869 or 8.69%. That's the weighted average cost of capital. Now, the total dollar amount of capital employed is 0.0869 multiplied by 8.69, 8.69%. That's your weighted average cost of capital. The total dollar amount of capital employed is 0.0869 multiplied by 15,000. So that's 1,303,500. That's now your total dollar amount of capital employed. So it's taken by multiplying the weighted average cost of capital by 15,000. Okay, so we have now requirements for number 3, uh, exercise number 3, requirement 2. Then we compute for number 3, calculate the economic value added. So for the economic